Hello everyone, I'm Hong Chuan Tan, a Director of Transfer Pricing Solutions Malaysia. Today I'm going to talk about the new TP requirements and penalties in Malaysia for 2021. Before I get into the topic, a quick overview of our firm. We are a specialist firm that provides practical, proactive, and cost-effective transfer pricing advice, and we are made out of a group of advisors from the Big Four and the mid-tier firms based in Malaysia, Australia, and Singapore. I myself, as the Director of Transfer Pricing Solutions Malaysia, has more than 10 years of experience in providing transfer pricing advice within the Asia Pacific region for multinational enterprises in a broad range of industries. Okay, as you are aware, the COVID crisis has impacted the economic situation globally, including Malaysia, whereby economic stimulus packages are provided to help individuals and companies transition through the economic retraction. With this in mind, the government would need to obtain funding from different channels, and one of the channels will be from transfer pricing. The recent changes has shown that the Malaysian Tax Authority will be aggressive in conducting transfer pricing audits on all fronts, as based on my experience, transfer pricing is a low-hanging fruit for tax authorities to obtain income. The Malaysian Finance Bill 2020 was released following the tabling of the 2021 budget on the 6th of November 2020, whereby they have incorporated, TP-related changes to the current ITA, and the change permits significantly greater authority to the MIRB and re-emphasizes the importance of TP compliance with effect from 1st Jan 2021. Let's go through the key amendments that was incorporated. The key amendments made following the release of the Finance Bill 2020, which was gazetted on 31st of December 2020, are the penalty for failure to furnish TP documentation, surcharge for TP adjustments, transfer pricing documentation to be made available within 14 days upon request, and tax authority have greater authority to disregard structures in a controlled transaction. Let's first look at the penalties for failure to furnish TP documentation. Prior to 1st January 2021, there was no specific provision in the ITA on the imposition of penalty for failure to furnish contemporaneous transfer pricing documentation. Effective 1st Jan 2021, a new section 113B in the ITA is proposed to include the penalties for failure to furnish transfer pricing documentation to the Malaysian Tax Authority on time. Now, there are two elements. First, if it's on conviction, the penalty is of 20,000 ringgit Malaysia to 100,000 ringgit Malaysia, or prison term of up to 6 months or both. And when you fail to furnish TP documentation within 30 days, if the TP audit is performed before 1st Jan 2021, or 14 days effective 1st Jan 2021, or any other period decided by the court. Secondly, if without prosecution, the penalty can be up to from 20,000 ringgit Malaysia to 100,000 ringgit Malaysia. And additionally, you could also appeal to the Special Commissioner of Income Tax within 30 days. Now, next up would be the surcharge for transfer pricing adjustment. Prior to 1st Jan 2021, a penalty is imposed on TP adjustment resulting in additional tax payable. So the penalty is on the additional tax payable. And the penalty cannot be imposed on businesses with no tax payable. For example, if businesses were incurring losses even after the tax TP adjustments. Effective 1st January 2021, Section 140A3C has introduced a surcharge of up to 5% on all TP adjustments. So this means that it will apply irrespective of whether there's any tax payable on the adjustments, regardless of whether you are making losses or not. And the collection of the surcharge will as if it was tax payable. This is a key point where previously there were circumstances where companies are not concerned with the TP adjustment because it may end up being less penalties as possible because they're incurring losses. Next up would be another huge one, which is transfer pricing documentation to be made available within 14 days. Prior to 1st Jan, it was within 30 days upon request, which, based on our experience, has been a tight time to actually prepare a TP documentation to be furnished and finalized to the Malaysian Tax Authority. And with this new change, effective 1st January 2021, the Tax Authority can request TP documentation to be submitted within 14 days upon request for TP audit cases which have commenced on or after 1st Jan 2021. This change would mean that taxpayers would most likely not have enough time to prepare their TP documentation on time, which means it will be a greater concern for those that have neglected to prepare TP documentation previously. Next one would be structures disregarded in a control transaction. So prior to 1st Jan, the provision in relation to power to disregard can be found under the income tax TP rules, where effective 1st Jan, the rules will not be imposed to be inserted into the ITA, which empowers the Director General of Inland Revenue to disregard and recharacterize any structures adopted by a person in the control transactions if the economic substance differs from form or the arrangement lacks commercial rationale. This strengthens the argument for the OECD where economic substance is greater than form, and that the transaction itself will require commercial rationale or commercial reasons to exist as a control transactions. Now, I'll just go through a simplified example on how the penalty and surcharge will be imposed on companies in Malaysia. Let's look at this illustration where a Malaysian company is a subsidiary of the parent company in Thailand, where they have they're involved in related party transactions. In the event of an audit and the tax authority has settled in a TP adjustment of 3 million upwards in adjustments, and even after the TP adjustment, the Malaysian company was still in loss-making position. What penalty will be imposed before or after? So prior to 1st January 2021, a penalty will not be imposed as the company is loss-making, or rather, there will not be penalties on the TP adjustment because of the loss-making position. And effective 1st Jan 2021, first there will be a surcharge of 5%. regardless of whether the company is loss-making or not, which means that would be a penalty of 150,000. And then if this is in the event where the Malaysian company will not be able to furnish that transfer pricing documentation on time, then it will be slapped with a penalty between 20,000 to 100,000, depending on the complexity of that case. So, upon looking at the new revision, the taxpayers that will be greatly affected will be the small and medium-sized enterprises, where, if you're aware, the introduction of Malaysian Transfer Pricing 2012 with the introduction of the transfer pricing declaration in a corporate tax return in 2024 were first introduced, and transfer pricing awareness has increased from there, where multinationals were made aware to prepare transfer pricing documentation. So these are the companies that has reached the threshold imposed by the transfer pricing guidelines in 2012, which is revenue of more than 25 million and real party transactions of more than 15 million. So which means those companies that has not reached this threshold, mainly the small and medium-sized enterprise SMEs within Malaysia, would have neglected to prepare due to the lack of penalties, as well as them deeming the transfer pricing compliance was not necessary at that point in time. With the introduction of the fixed penalties, as well as the shortened timeline to furnish the transfer pricing documentation upon request, now SMEs that have not prepared any TP documentation beforehand are effectively caught under this regime, which will force the SMEs to be compliant. So the main thing is SMEs are now will need to be proactive to start preparing the contemporaneous transfer pricing documentation this year. Now, I'll just sum it up on what we have discussed earlier. Right, with the introduction of the new section, the Malaysian Tax Authority has made it very clear on the importance of preparing contemporaneous transfer pricing documentation to avoid the possibility of severe penalties. To be precise, the TP documentation should be prepared for all open years of assessment, which is the last 7 years. So basically, the tax authority can look back 7 years for any transfer pricing related issues, and that the TP documentation should be readily available by tax filing due date and will be readily submitted to the MIRB upon request. Because with this change, 14 days will not be enough time for taxpayers to actually prepare a transfer pricing documentation. And most importantly, is to be noted that as long as companies are involved in controlled transactions, the companies are required to prepare contemporaneous TP documentation, either the full-fledged or the simplified transfer pricing documentation. Now, the introduction of the surcharge strongly indicates that the Malaysian Tax Authority will rely heavily on TP compliance and put greater emphasis on TP audits going forward. The 5% surcharge can be detrimental for multinationals with high level of complex transfer pricing transactions, where previously they were loss-making. That even 5% of a TP adjustment be detrimental. If you look at the examples that we have given earlier, a mere 3 million transfer pricing adjustment would have incurred 150,000 worth of penalties. So that imposition of the surcharge would mean that the companies will need to ensure the control transactions are carried out on an arm's length basis, and be mindful that the surcharge can be imposed irrespective of whether the companies have tax incentives, unutilized allowances, or business losses. Now, as mentioned earlier, this TP documentation will need to be made available within 14 days if the TP audit were to happen effective 1st Jan 2021, right? So going forward, 14 days will be the norm as opposed to 30 days. So which means the taxpayer will need to be contemporaneous and make sure that TP documentation needs to be prepared hopefully by the time that you file your tax return. That would be ideal. If not, a failure to furnish the TP documentation will lead to the possibility of severe penalties being imposed. Lastly, structures disregard in a control transaction. This is more to be in line with the OECD guidelines, where economic substance should not differ from form, and that every controlled transactions that you have or may have in the future should reflect commercial reality, and that every controlled transactions will need to have a commercial reason to justify why it has taken place. With that, I've concluded my topic on new TP requirements for Malaysia, as well as the new hefty penalties for 2021. Lastly, if you require any assistance with preparing the TP documentation, or at least having any transfer pricing advice in relation to your Malaysian subsidiaries or Malaysian company, feel free to actually contact us from the following details. We will be contacting you as well shortly. Thank you.